The next installment of our Market Matters series. We think you'll enjoy this session today as we're taking your input and how we can make this webcast better and incorporating our first guest speaker. So we're really excited about that. That being the case, I did want to alert you to the fact that today's webcast will likely be a little longer than typical 30 minutes, so we can give some time to our guest speaker today. I think you'll find the extra time is worth it. And by way of just an introduction to expanding at the Market Matters series, we'll probably have, we've got a nice slate of guest speakers on the horizon to look forward to from a variety of topics, just to basically broaden the thought pool. And I think varying opinions are always popular, good to have. So let's turn to the agenda for today. What we're going to do is we're going to follow a similar format to prior Market Matters. I'll review the current COVID-19 fact pattern, because I do think that still does play a big role in what we're looking at today from a markets perspective. Then we'll move to the economic and market implications. And then after that, we'll turn it over to our guest speaker here on the screen, John Tousley from Goldman Sachs. He's a market strategist within their private wealth management group. And he's got some great comments and thoughts, not only on the economy, what Goldman sees from an economic standpoint, but also 2020 and the U.S. election and political implications. So with that, let's get started. Similar looking charts here. I think this is always good to reference a common point and a common chart potentially. Again, this is from JP Morgan. And you can just see, relative infection curve by population type or by country and where they are in their trajectory. And notice a lot of countries, it does appear, have turned the corner from a new infection rate, with Germany rapidly sliding down the new infection curve. US and UK still trying to get over the hump from a new infections perspective, which is a bit, it's disappointing, obviously, given that some European countries started about having issues around the same time as we did. But nonetheless, it does appear, as you'll see in the next slide, that U.S. testing or results per day are starting to ramp up a little bit, which is, again, that's going to be the key to figuring this all out. Not only knowing who has COVID-19, but also who's got antibodies that might be useful in treating other folks, tracing people that have gotten it more than once, and then quarantining those that have it. And that's going to allow us to open up the economy in a fuller way, and that's likely going to be a key next step. And as the Trump administration indicated, either as last night or day before, they've already begun work on the tracing aspect of all this. So we are hopeful, and that would certainly pave the way for a brighter future. Here's an interesting slide that I picked up off of a Homeland Security presentation, and that is, it does appear that COVID-19 does not respond very well to direct sunlight or even indirect sunlight. And you can see, I think over here is the key, because it might inform us as to how we can start reconfiguring office spaces or public spaces, buildings. Likely the older buildings with fewer windows might have an impact on valuations, interestingly. You can see, in full sunlight, the half-life of COVID-19 is only roughly 2 minutes. Half intensity light, meaning indirect, you got about 3 minutes, quarter intensity on and so forth. No decay, obviously, with no sunlight. But again, I do think that this will have or inform maybe the way policymakers or not policymakers, but potentially building owners and businesses look at what parts of the business or where they can open up office space and where they shouldn't potentially, or take mitigating factors to open up those spaces without direct sunlight. So anyway, just an interesting tidbit I found that I thought you might appreciate. And then some articles of note, as I think this is a nice section because it does give an interesting cross section of what's in the zeitgeist right now. Bloomberg had a great story about how, despite some of the setbacks we've had from a testing and tracing standpoint, it does appear, that the handling of the virus and the death rate is lower than it could be, all things being equal. Interestingly, this one, maybe it's gone unnoticed, maybe not by some of you all out there, but apparently the leader of North Korea has gone missing for the better part of 2 weeks. And that is causing, and what's important about this is that he missed a very important cultural celebration, which I think every dictator in North Korea has shown up for over the last 70 years. And that leaves obviously a succession question to a very vexing issue in the Korean Peninsula. But that was just something to keep an eye on for sure. And then in prior weeks, I mentioned how the Gates Foundation was funding actually the 7 most promising treatments out of the foundation directly, knowing that only 2 are going to survive. And it looks like now they've kind of cut off most every other project they're working on right now and made it their full and total priority, which I think, again, if anyone can find a solution to this intractable issue right now, it'd be the Gates Foundation. It's not going to necessarily be a full government solution. So looking at some of the economic and investment implications over the prior week or from COVID-19, similar notes from prior weeks, but I do think it's important to note that the market's been rallying recently on reopening optimism, with testing optimism, and even the vaccine optimism. And that is likely, potentially, it's nice because it might get us to our 3,000 point on the S&P, which would be our trigger point to rebalance accounts again. Having rebalanced them on the downside at around March 13th at about 2,400 or so. Getting back to 3,000 would be a 1 standard deviation move relative to the last time, or 1.5 roughly, last time we rebalanced. And I think that would be a good opportunity to basically reduce equity, add to bonds and alternatives, which would be what would happen at that rebalancing. Again, continue to reinforce the need to hold shorter term cash needs, liquidity needs in cash. And that can be, either straight up, money markets or, ultra short term bond funds, but certainly having that cash available, given the market volatility is important. And I did want to keep on here, as I mentioned down in the alternative section too, inflation hedging is becoming much more of a priority. I think typical inflation signals that aren't necessarily driven by the bond market, like gold, is potentially telling us that something might be awry with over the long term from all the monetary largesse and fiscal stimulus that we've pumped into the economy recently. Earnings season has kicked off, and I'll show you some examples of what I'm talking about here in the next couple slides. But it looks like, similarly to prior periods, small companies are doing pretty poorly in the current environment. Not really surprising given their reduced access to funding, and larger companies are doing okay. Active management is actually showing some really good performance potential right now, so we continue to allocate away from index exposures, and I think it's setting up very similarly to and prior periods in time where active management has really shown through, and I'll go into why in just a moment. Fixed income is becoming less attractive now that spreads have tightened, meaning that bond prices have risen and yields have fallen. That's what spread tightening means. But there do continue to be some good opportunities in investment grade. So we're being very cautious, being very careful, but we do want to be mindful of opportunities there. And then inflation protection, as I was saying, is becoming pretty cheap right now because no one really believes it can happen. So let's look at the equity markets just for a moment. And again, I think it's important to revisit the year-to-date picture because it does tell you what's going on over the last, 4 or 5 months is really equivalent to about 2 to 3 years worth of volatility. With the S&P now up, more than most other international indexes or other equity indexes. In red there, you can see it's down only about 11.5%, 12%. This was through last Friday. Emerging market stocks and international developed market stocks like European stocks are all kind of coalescing around this down 21%. So a pretty big distribution of return here, the difference between S&P and international. Some of that has to do with the US dollar, but not all of it. And then of course, small cap, which has actually started to reaccelerate recently in the last couple of days, is still quite a bit different in performance than the S&P right now. And as you may recall, we have no exposure to small cap stocks right now. We have an underweight to international and have almost no exposure to emerging markets. So our positioning coming into this crisis was actually pretty positive from a differential standpoint. The emerging market situation, and again, this also maybe speaks to the process we look at when we're talking about emerging markets. The Brazilian market, I think, is a case study as to why you need to be careful or buyer beware. Not only is it levered to the petrochemical sector, but also it's got a really awful corruption and governmental nepotism problem. And you can see, after having rallied, this is a 5-year chart, by the way. S&P is in red, and the MSCI Brazilian index is in blue. After having rallied basically 80% or so from April of 15, it's now down 17. So a massive reversal of fortune. So again, a lot of that has to do with the fact that the Brazilian real, their currency, versus the dollar is down, I think, 30% over this time. But also the remainder of that is that there's been challenging economic conditions in Brazil. So it's really, I think, is a case study of a buyer beware situation, and why, again, if we were to add to emerging markets, which we've just started to recently, having an active strategy where you can avoid some of these pitfalls is critical. Turning to earnings season, this is a picture of companies due to report this week. This is the week of April 27th. Here we are today on Tuesday, and we've already had a number of bellwether companies report. 3M, UPS, Pfizer, all actually reporting decent earnings, nothing crazy, as you might imagine. But Pfizer, interestingly, is showing a pretty strong pipeline. So I think that's part of the reason why Pfizer is doing well today. But ones to look for, that are really more bellwethers, I would say, would be the big tech companies. After the bell tonight, you've got Google, parent company Alphabet, Microsoft, and Facebook on Wednesday. Those are going to be key, because that does tell you the degree to which ad spending or cloud migration is still occurring. Those are secular trends that need to be tested with these earnings reports to just see how those are evolving. Amazon, we already know that Amazon's probably going to been probably the biggest winner in this whole COVID-19 crisis, as maybe indicated by the 3 to 4 deliveries that come to my house every day. But we'll see. We'll see what the actual output has been. Apple, interestingly, they just released a new, very low-cost handset. Not that that's going to be impactful for the prior quarter, but again, they're a tech bellwether, and we'll see what kind of impact COVID has had on handset adoption. And then finally, the energy sector is going to be key, because as you'll see on the next slide, energy has really been the locus of where most of the earnings disappointments have come from. And I think this is from FactSet, and what the chart shows you is the S&P split out by by sector. You have the communication services on the far left, energy on the far right. You can see what earnings growth has been for Q1 today, which is the blue bar, versus what it was on March 31st. And you can see, actually, despite the fact that the S&P itself, earnings in aggregate are worse by about 9 percentage points or so, there are sectors that are still holding up. I mean, particularly consumer staples, that's a pretty big differential, surprising to the upside. IT continues to have a very positive tailwind to their earnings stream. And then communication services, those would be companies like Facebook, Alphabet, and the like that we use every day. As you know, our big focus has been on healthcare, and we think that's a really strong secular trend we can sink our teeth into, because demographics, I think, are going to play a role in usage of the healthcare system, and that's not going to change anytime soon. You can see where the big hits to earnings have been, as you might expect. Industrials, if no one's making anything right now, then industrial earnings are going to get nailed. Energy, with the price of energy collapsing over 60% this quarter alone, you've got a pretty big hit to earnings here. But financials have been the big surprise to the downside, because no one was really expecting them to reserve as much capital as they have, I thought they would, against loan losses, bad loans, essentially. Same with consumer discretionary. No one really kind of knew how many stores Starbucks was going to shut down. Turns out it's going to be all of them. And so, of course, that's going to be a big hit to earnings. But, if you can concentrate your equity allocations and active strategies to the sectors in green and avoid the sectors that are in red, as I think we've done a fairly decent job of this year so far, then your returns can be really very different than the S&P, which again is very similar to 2000, right? If you avoided some of the obvious bubbles of 2000, like technology or non-profitable technology for that matter, then you stood you had an opportunity to have pretty positive performance even during 2000, 2001, 2002. And this is the chart I was telling you about as to why active management, I think, has a pretty good opportunity set right now. And this is from Goldman. So it shows the dispersion of S&P stock returns. And dispersion is just a fancy word for differential between some of the best performing stocks and some of the worst performing stocks measured over a 3-month basis. The higher the dispersion, the better the opportunity set is for active management. You can see, I think, the reason why indexes did so well in the post-GFC period has everything to do with this period from 2010 dispersion to where we are today, where there was very little dispersion between the best performers and the worst performers on average. And because of that, indexes could just ride along and be completely sufficient for return generation. Now I think that's changing. And I think, again, at every paradigm, recessions typically tend to be the catalyst. This dispersion changes the game a little bit. So I'm a big believer right now in active management. Moving to fixed income, this again is a bit of a tricky story right now because there's been a significant re-rating in the investment grade bond sector. So think, AT&T, Verizon bonds, on average, we're down at the peak of, or the trough of the more recent COVID crisis, down 17 or 18%. Recall that the Fed stepped in to support this market with ETF buying in the corporate side as well as direct company support. And so that's caused a re-rating on the investment grade side. Interestingly, even though they've announced support for the high yield sector, or what they call fallen angels, which is basically companies that were once investment grade that are now not investment grade or junk, look at what's happened recently to the high yield market. It's kind of trailed off here, telling a bit of a different story than the investment grade or the government market up here. And this is as exemplified by this green line, which is the high yield market. Similar situation as well to the emerging market bond sector that are denominated in US dollars. And again, going back, I showed this slide last time, but I do think it's relevant to the current situation that we're in. And that is, in times of substantial uncertainty, markets don't tend to move around. I mean, they tend to move around a whole lot, but not really get anywhere. And that's called this sideways action that you're noticing here, where there was substantially long periods of sideways market activity in the S&P. Well, I guess it's like a reconstructed S&P back in the 1800s, probably using the Dow Jones Industrial Average as a splice. But you can see, the market really didn't go anywhere in the lead up to the Spanish flu, through World War I, and then through the other side of World War I. It only, the Roaring 20s only started to take off, right about here in 1923, 24. I think we're kind of approaching a similar paradigm right now, where you've got, significant amount of uncertainty. Some damage will likely be done. We're probably not going to recover to the GDP levels that we just recently experienced in February till I think February 2021, or by some estimates. So that would just make sense that stocks wouldn't necessarily get more expensive. They would just kind of chop around for a little bit. And then this is what I was talking about, inflation. So this is the 5-year, a picture of inflation expectations. And the way you construct the inflation expectations from a market standpoint is that you take your 5-year Treasury and then you subtract out the 5-year tip U.S. Treasury. The difference in those two is your inflation expectation that the market has for the next 5 years. And you can see it's kind of trended down here recently from the target Fed funds rate or Fed rate of 2% down to, it got as low as, below 1% earlier in the year. Now back up a little bit. But, my point here is that if everybody expects no inflation for the next 5 years, I think that tends to be a pretty consensus thought right now. What could go wrong, right? What could possibly go wrong? And I think that inflation may be underestimated right now. So again, we're looking at ways to account for this inflation underestimation, and various ways to do that. So we'll certainly report more back on that. It could be things like infrastructure securities, allocating to infrastructure securities, or treasury inflation protected securities, or things like commodities or gold, things of that nature. So let me just sum it up here before I turn it over to John. And here are a few items that I wanted to touch on. One is that the news flow, again, is going to continue to be pretty ugly. I mean, we're printing horrid numbers on almost every measure you can find that's an economic measure, and that's likely to be the case until mortality rate turns lower and we open the economy up. Sideways markets are our best estimate, with potentially a retest of the March flows sometime this year. What would be the catalyst of that? Well, I mean, certainly earnings season so far hasn't been that catalyst, but it could be something like the second wave of infections maybe later on in the fall, potentially. Earnings have been better than expected so far, which is great. I mean, companies are adapting rapidly to changing conditions, so that's certainly great to see. And then index investing, I'll just reiterate this point, is becoming a lot less attractive with return dispersion rising. And as you may recall, we have had index exposures in our portfolios. Some of the activity you're seeing right now is calling out some of that index exposure in favor of active strategies. So we think that's a good course of action. So with that, I will unmute John, and he is going to go through a slide deck that Goldman has prepared, and then we'll just have some Q&A, some casual conversation afterwards. John will stick around, and we'll take it from there. So John, if you would, by way, just give a little introduction to yourself, and we can just push on through to whatever you wanted to push on through to.
You bet. Good afternoon. I hope everyone is healthy, safe, and well, and enduring this period of physical distancing. It's certainly been unique. As you can tell by the picture, I am working from home today, as I have for the last several months. And it's been interesting. I think my kids finally realized that their dad actually does have a job. Before that, I wasn't sure they believed that. I have been with Goldman Sachs for coming on 20 years. I'm a managing director and the global head of market strategy. So I have teams in London, New York, reporting into me. I actually reside in Salt Lake City, Utah, and I've been here for about 4.5, 5 years. Goldman Sachs has a very large presence out here. Prior to being with Goldman Sachs, I was a portfolio manager with particular emphasis in municipal securities and broader fixed income. I'm just going to go through a handful of slides, and Todd, if we would just turn to the executive summary, the first opening slide. And I'm sure over the last several weeks in working with Todd and the team, you're familiar with a lot of these numbers. And so I just want to bring a few of these to life. I'll talk about sources of volatility that you're familiar with, some sources of stability and some good news that's in the system. We'll touch a little bit on what that means for our growth views, and then we'll talk a little bit about what may have changed in terms of the political landscape over the last couple months. First and foremost, again, I think we heard expertly about COVID earlier on this call. What makes it so incredibly challenging is that 80% of those who have been infected are either have mild cases or asymptomatic, and may be asymptomatic for as many as 14 days, if at all, before that we can identify it. And so the containment of this has been particularly challenging. And when you contain a virus that has mild symptoms for the vast majority of the population, you have to do very draconian things like shut the economy down, physical distancing, social separation, whatever we want to call it. And the result of that has been a sudden impact to the global economy. And so I put on this page a couple records. The speed at which we declined from the peak of February 19th was unprecedented. Conversely, the speed at which we have recovered from the bottom of March 23rd has also been unprecedented. And the fact that we have recovered more than 50% of our plunge, historically, when you've come off of the bottom by at least 50%, you have never revisited that low. So one of the things I will tell you is, while I don't expect an end to volatility, we think we have moved past the absolute lows of this particular downturn. Speaking of lows, we saw for a brief moment of time, the entirety of the US Treasury curve moved below 1%. Last week, we saw a record low with oil trading, the May contract closing at a negative $38 price. I want to assure you that while these are unprecedented, make for very interesting charts, it was a very specific moment in time, a contract for West Texas Intermediate for settlement and delivery at Cushing, Oklahoma. As I've tried to explain to my mother, who thought there was a conspiracy going on, that there's probably 80, if not 100 prices for oil. We choose one to follow. The rest of the oil market was not experiencing the same degree of volatility that this particular contract was. Suffice it to say, it was a collision between low demand, low available storage, too much supply, and this contract expiring. But we saw some incredible lows over the last couple of months. We've seen some very large highs, and I would say a number that is normally ignored, initial jobless claims, is a number that each Thursday now we watch very closely. And we have had a total of 26 million people who have filed over the last 5 weeks initial jobless claims. This Thursday's number is expected to be about 3.3 million. And here's the irony of the data. Those are terrible numbers. It suggests that we are clearly on track for a 15% unemployment rate. But these numbers are becoming less abysmal each and every week. And so technically, the way you define recessions is the bottom of the recession is at the low point. That's when it ends. And as the data starts to improve, we may have entered this recession in March. We may have exited in April. It's going to be incredibly brief from a data standpoint. As you know, fiscal policy has been huge. We're now at the point where the phase 3 program has delivered about 2.8 trillion, just that phase 3. And that represents about 13% of GDP. That is 3 times the amount that we saw in 2008. And monetary policy has delivered a significantly larger amount or dose of quantitative easing than we saw in 2008. Just to put that in perspective, when the Fed was building its balance sheet in 2008, the largest purchases it had done was 120 billion a month. This number is going to slow down, but the Fed so far has a run rate of building their balance sheet of buying securities at 66 billion a day. And so totally dwarfing what we have seen in prior episodes. And so if at any point you've scratched your head and say, how does the market recover with earnings so abysmal, economic data so poor, volatility so high, dividends being cut? How does the market recover so quickly from, we're still in the midst of this tough news? And part of the answer is this outpouring of targeted but broad, large fiscal and monetary policy. Basically, policy is helping paint a horizon to recovery, and that has been really effective. So while fundamentally it's tough to argue for the data to be where it is, policy-wise, I think you can get there. Peak uncertainty, just to give you a couple of points of data, the volatility index, the VIX, which is running about 34 right now, got as high as 82.7. I'm sure for the average person on this call, that means nothing. The key takeaway is that record high, it would be normal when we were in March to have each and every day move at least 6%. Typically, we have maybe 1 day, maybe 2 days a year that will have that magnitude of move. It was suggesting that was going to be the average move. And in fact, in March, the average daily move for the month of March was 5%. That was the largest, most volatile month ever. The next second place month was November 1929. So everything we've seen in the last 2 months, unprecedented, uncertain, and frankly, quite a bit unbelievable. Now, if we move to the next slide, we'll see that we all understand some of the rationale behind it. We've talked a lot about the virus. I'll save that as a source of volatility. You know well about that. In the midst of all of this, and we'll touch on this in greater detail, we've had a market having to reprice to a new election expectation. 2.5 months ago, the market was basing its views on two assumptions. First and foremost, that President Trump's opposition candidate, the Democratic nominee, would be Bernie Sanders, and that would be a very far left progressive candidate who would be fairly easy to defeat on head-to-head competition in the key states I show you here: Arizona, Michigan, Pennsylvania, Wisconsin, North Carolina, and Florida. The second assumption was that President Trump would be enjoying a strong economy into the election. So neither of those two assumptions are true. The market has had to reprice to a different reality, a much more competitive reality in terms of polling in these key states. We'll talk a little bit more about that in just a minute. The other issues I think that are just important to remember is when you think about volatility in the markets, sometimes it's fundamental and recession driven, the uncertainty about an economic downturn. Other times it is driven by liquidity and the functioning or the lack of functioning in the market. And that will amplify many of the moves in the market. In fact, today, roughly 80% of all equity trades, 90% of all futures trades and currency trades trade algorithmically without any human interface whatsoever. And that has generated tremendous liquidity during periods of stability. It can amplify volatility. And one of the challenges we saw, and you can see this on the bottom right chart, was the bid-ask spread, the cost of trading in and out of stocks, even large liquid stocks like the S&P 500 index became very expensive. And that's a sign of stress liquidity. Because of the Fed's measures, we feel like we've made it through a good chunk of the uncertainty around liquidity. We go to the next slide, we can just recognize that lest we lose sight of some of the things that are helpful and function in the economy, we've talked about the first two boxes, the fiscal stimulus, now at 13% of GDP. We now have basically every major central bank creating some degree of stimulus and accommodation. In the example here where I show 9 of 10 central banks, it's simply the Bank of Japan doesn't have any more room to ease rates, but they've certainly produced additional stimulus notwithstanding the level of interest rates. Inflation, again, in the near term is contained. I completely agree with Todd that we have to look at what the other side of this looks like down the road. And when everybody's crowded on one side, that certainly is a worry. But for the time being, inflation or low inflation allows fiscal policy and central banks to basically be pedal to the metal, full steam ahead, whatever the analogy you want to use in terms of trying to support a recovery. When confidence does return, the housing market will have a large number of households that could financially benefit from refinancing. Now, we know lending standards will tighten up, and we're already seeing that happen with some of the FICO scores and things like that. But ultimately, we may see a recovery where we have some refinancing opportunities, and households entered this downturn in very good shape. The bottom right chart shows you that household leverage was at a 34-year low, and our savings rates were really high. I would suggest to those listening on the call today that there was an echo, excuse me, an echo from the global financial crisis where we didn't have the V-shaped super strong recovery you typically would have out of a deep recession. It was more shallow, it was more conservative. Households delevered, they lived within their budget. They recognized that their home, their largest investment, they needed to be a little smarter with how they levered their house. And so we have seen a more shallow recovery. I would suggest that put this economy on better footings than we've seen in other downturns. And it's the health of the private sector that will enable a reasonable recovery. I would also suggest that when we think about the recovery, we're going to get another echo. And the echo is going to be not only are people a little more conservative with their balance sheet because of the uncertainty of financial and economic issues, they're going to be a little more conservative with their balance sheet because of medical issues and virus issues. And there's going to be an echo from this recovery that probably keeps things a little more elongated and conservative coming out of this. And so in terms of our economic forecasts, Todd, if you move forward a couple pages, there'll be a table, one more, and this has our economic forecast. And you can see in the middle of the column under GS, our 2020 expectations. Our growth expectation for the U.S., and I'll update this because some data has come in, is for the U.S. to contract about 5.7% this year. That's versus an original pre-COVID-19 forecast of about 2.3. Europe will be down about 9%. China, +3%. And global GDP, I want to update this number. We showed down 1.8%. We now believe it will be down about 2.7%. So we are all witnesses on this call today. We are all witnesses to the greatest global contraction in breadth, speed, and magnitude in modern history. We will also be witnesses to the greatest in breadth, speed, and magnitude global recovery. And this will be a very unique recession, front-end loaded, event driven by a virus, but it'll be resuscitated by massive fiscal and monetary policy, generally a healthy corporate sector, a very stable private sector, and all the underpinnings for a reasonable recovery we think will be in place. Now, let me just, with a couple more minutes, do some political comments. If we move, it's probably going to be around slide 18. We'll have a map of the United States. And just to talk a little bit about the election backdrop. Now, first and foremost, what we show you here are the comments about the election and the path to 270. And as we know, it's not a race in the Electoral College of 0 to 270. Each candidate starts with a certain amount of predetermined, somewhat baked expectations. So the blue states are those states that either are solid Democratic or lean Democrat. And so Joe Biden will likely start the election with 233 electoral votes, largely baked and expected to be delivered. And that'll come from obvious states like New York, New Jersey, California, the coastal states in many examples. And then we have Donald Trump that is likely to begin the evening with 204 electoral votes. Those are the red states, and I think we're all familiar with how this math works. So in order to get to 270, the states that are largely in play are those that I highlight in yellow: Arizona, Florida, North Carolina, Pennsylvania, Michigan, and Wisconsin. And you can see the electoral votes. There's basically 101 electoral votes up for grabs. Even though Joe Biden is polling relatively well in all 6 of these states, the prevailing wisdom is that Donald Trump will win Florida and North Carolina. So I'm going to simplify things a little bit. Basically, President Trump, we expect to win Florida and North Carolina. That leaves 4 states in play. He must win 2 of these 4, or it's over. It's just that, it's kind of that basic. I often tell investors, if you want to simplify the election, it comes down to one word, and that word is Wisconsin. Wisconsin will have just enough electoral votes to get him to 270, and it is demographically the most likely of the states he could win. But as I've said earlier, Joe Biden right now leads in the polls in all 6 of these states. So it is incredibly competitive at this point. If you look at predictit.com, it would suggest that there is about a 52% probability Joe Biden wins the election. Let's just say Joe Biden does win the election. What does that mean? If we go to the next slide, I want to talk a little bit, or one more slide. I'll wrap up here, and we can open up for any questions. If you think about how policy is determined, there's really 3 major lanes that policy can be achieved. It can be achieved through bipartisan or semi-partisan legislation with 60 votes for major legislation. So healthcare coverage, environmental, immigration, things like that. You need a 60-vote majority to get those large pieces of legislation accomplished. The one thing that is fairly certain is if you look at the composition of the Senate right now and the competitive states that are up for re-election, if there is a blue wave and the Democrats win all the competitive seats that are up in the Senate, that would take them to a 55-seat majority. If there is a red wave and the Republicans pick up the competitive seats, that would take them from a 53-seat majority to a 55-seat majority. So from an election standpoint, the best any party can realistically do in the Senate is a 55-seat majority. That means that the 60-vote threshold for one party to drive through legislation is unlikely to be achieved. So that means you are going to be somewhat limited on a policy standpoint to reconciliation and executive order and executive action. And so I put a list here of things that can generally be accomplished through reconciliation and executive order. Reconciliation only requires 51 votes. The vice president can count for that 51st vote. And there are things that would likely happen under a unified Democratic leadership. You could get a public option in reconciliation. You could get stricter environmental legislation on carbon tax. You could do student loan forgiveness. You could unwind and reverse President Trump's tax policies. Now, the trick with reconciliation as it currently is designed is you get three options a year at reconciliation, and they have to be related to spending, revenue, or environmental issues. The reality is that you only get so many at-bats, and one policy, one piece of legislation could actually check all three boxes. So you cannot use reconciliation for anything you want. You have to be very strategic in that approach. They would likely, if Democrats were to win all houses, probably work and use reconciliation towards tax code reversal and healthcare issues. Most likely, you'll find that the next president will be in the same situation that the current president is in, a non-functioning Congress that limits legislation to executive action in an executive order, half of which will end up in court. So I don't want to suggest that the outcome doesn't matter. It clearly matters in terms of legislation. You probably cannot get an environment where you're going to get one party that can move legislation through without some bipartisan support. There's limitations on the number of legislations you can do through reconciliation, and likely most of the activity legislatively will be through executive action and order, and you can see those lists of issues. So the election matters. I think as we get into the summer, the markets will start to reprice some of those outcomes. Don't pay too much attention to the polls right now. And the last point I would make is I think we should all be politically active, all politically involved, but you express your enthusiasm and your view with a vote, not with the trade. I have done exhaustive research on trying to make money politically in your portfolio, and it can't be done. It's not repeatable. It's not statistically significant. So be active, but do it with a vote, not a trade. Todd, I probably have 5 minutes of availability for any questions that might be in the queue.
Yeah, John, thanks for running us through that. That's been it's been a great addition for everyone's knowledge here. One thing maybe that I touched on in my earlier remarks that I would just like maybe the way you guys look at it at Goldman potentially are ways to address the issues would be this kind of delicate balance we've got right now between inflation and deflation, which I think is, in my opinion, it's really going to be one of the more hallmark issues for the 2020s, if you will, not too dissimilar to the 70s. So, I saw your comments and you made about, lower inflation expectations relating to PCE and things of that nature. How do you guys think, maybe a little bit more detail about inflation, and how would you be addressing that in a portfolio context?
So I think inflation as an investor is a really sticky topic because we measure inflation, we have these different baskets, and sometimes we have substitution, other times we don't. But the reality is what we quote as inflation is never the same basket as what you as an individual consume as inflation. As you get older, healthcare becomes much more important. Housing becomes much less important. So let's just start the premise with we don't measure it well at the individual level. What we do believe is that there has been, because of globalization and the mobility of labor and the mobility and the ability to move costs around, that in the last 30 years, we have structurally limited the ability to have much inflation in the system, and it has frustrated many a central bank that cost and price containment has largely been removed from the system. You might have pockets of supply disruption, but they've generally been viewed as temporary. We have, as consumers, shrewd American consumers that will rotate. So when you see avocados get expensive, you buy carrots or something else. And so there's a very strong replacement mechanism to address, and rotation mechanism to address with inflation. So I do believe, as a general rule, that marginal inflation has largely been contained. I think the inflation we worry a little bit about is the financial inflation and how reliant the US economy is for global investors to fund our deficits. And as long as the US is tier one capital and the only place to go for liquidity, predictability, and quality of debt and currency, we've enjoyed being fiscally irresponsible for decades. And in fact, every week we go to the market and say, we've been fiscally irresponsible for the last 40 years, will you please buy our debt? And the market says, yes, we prefer your version of fiscal irresponsibility to ours. That game has an end to it. And it's not that there is a better option out there, but that our option becomes less good, for lack of a better word, and we erode the value that the dollar and our market brings. And so I worry more about financial inflation and the cost of financing our deficits in the future to attract the needed bid. Now, one of the mechanisms around that is, well, maybe the Fed becomes our buyer of all resort of our paper, this monetization of our debt, and that will erode your dollar. And so I worry, I don't have a near-term concern or an intermediate-term concern, but I have a financial concern that we are putting ourselves in a situation where we become very vulnerable to the global appetite for treasuries and dollars. And when that erodes, our prices have to go up and our currency has to go down. One other point. If I was to argue with globalization, I would say that we're also entering a world where we have seen peak globalization. And the tariffs started that issue, and this virus will amplify the issue where every country is going to say, I need to redistribute my lines of supply. I can't have everything coming through China. It can't always be the cheapest producer. I need domestic production of medical goods. 95% of the essential ingredients of ibuprofen come from China. Not because they have them, but because we've allowed that monopoly to be established. And so you're going to see a huge political swing in the pendulum where domestic manufacturing, domestic supply lines are going to be created and redistributed supply lines throughout the world away from China. And that's going to create higher prices as well. So I don't worry about rapid hyperinflation, but I worry about firmer prices as a political and financial result of where we are today.
Yeah, excellent. And you did touch on it a little bit. I think your comments on the dollar were interesting. Certainly, I think there is some problems with a strong or strengthening dollar. Let me get to one, but before we get to that, there's a question here which maybe you're uniquely able to answer. There's been a lot of talk right now about potential China litigation, if they are determined to be the source of this virus or whatnot. And to what degree do you think this is going to have any sort of impact on U.S.-China relations potentially, or even impact for investment opportunities for emerging markets that maybe focus around China?
Yeah, so I don't have a firm view on this. I think that we're in an election year, and in election years, you always want countries, people, industries to point at. Having been on Wall Street for 25 years, I certainly understand what it's like to be in the crosshairs of criticism. And so I think China is a very, very big target, not just for the United States, but for all economies to basically, float ideas. Maybe it is a coronavirus tariff. Maybe there's some political demand for some cost reimbursement. I think, while I don't know if it's economically feasible, it's certainly politically feasible. And so I think that you're going to see that enter the narrative. I think Lindsey Graham's already floated the idea of a coronavirus tariff. So it's going to complicate the world, and it's going to take our relationship with China from bad to worse. And that's going to probably serve political purposes for the next few months. But long term, I'm an economist, and I recognize that global trade and global relationships create wealth for everybody, and it increases the size of the pie. And I get worried when we deglobalize the world that while maybe our piece of the pie got a little bit larger, the overall pie shrunk, and then we're a net loser in that game. So we need to be really careful about the rhetoric behind any type of political retribution.
Right. Yeah, I completely agree. Final question here, which I think is probably a good one, well timed, and I think you might even have a slide on it. And I've given my thoughts, not too dissimilar, revolving around potential recovery trajectory and time to recovery to reach. And you and I talked about this a little bit yesterday. But based on what we know today, earnings, businesses reopening, and that time schedule looking like it's a little more accelerated than people had really thought, or maybe warranted. What's the idea on a time to recovery from where we were in January, February of 2020, from then, to that point?
Yeah. So I think it's a great question, and it depends what we're measuring in terms of recovery. Is it V, U, N, L? I think you're going to be able to find every letter in the alphabet that'll fit some part of this recovery. Just to put it in perspective, the unemployment rate probably goes to 15%. By the end of and it goes to the 15% probably in May, maybe early June. By the end of the year, it'll probably be back down to 7.5% to 8%. And it'll take another year to go from 7.5% back down to 4% if we get that low again. And so I use that as a basic barometer to say we're going to have a very strong second half recovery. If you go to slide, I don't know if you want to go to slide 4 in the presentation, Todd, but just to give you a little sense as to what it might look like. Do 5 for me. Sorry, my bad. So what you can see here are the different boxes are the different components of growth. And you can see the massive contraction in Q1 and Q2, the first and second quarter of this year, and then unprecedented recovery in the next 2 quarters. But in order, you can kind of just tell visually that Q3 and Q4 don't replace Q1 and Q2. It's a really healthy recovery. I'd say we get 2/3 of it back by the end of the year. It's going to take another year at least to get the last third back, if not a little bit longer. So we describe that type of recovery as a U. The markets are a discounting mechanism, so they won't wait for the data. And if you ever want to learn that lesson, just look at where we are right now in the markets. The market has not waited for the data to improve, and the markets will be V-shaped. And our target for the end of this year is about 3,000 on the S&P. I think you've got a really interesting target price to take some gains. So the markets will be well ahead of the economy on this particular recovery. I'll just add one last point. The COVID virus is also accelerating change. And so a lot of things that were happening slowly, the automation of service industry, a lot of things that were happening because of the shifting demographics of our nation have now been accelerated. And so the one thing that will be different is a lot of times in a recovery, you just buy the market. You get cheap beta and you just own the recovery. The answer this time, it's going to be different. And the strong get stronger, the weak get weaker. And we've seen that so far. Normally the companies that get beat up the most in the downturn have the best recovery. And that has not been the case. The companies that have done the best in the downturn have actually done the best in the recovery. And so I think the one thing, and Todd talked about this, is this recovery is going to be dominated by good companies getting better and weak companies getting worse. And that is going to have to inform your decision making as an investor. With that, I need to conclude my formal comments, and obviously thank you, Todd, for the time to spend with your clients and with you today.
Yeah, John, really want to take this time just to say thanks for spending some time with us. Really appreciate you carving out your afternoon. And I think that does take us to the end of our Q&A today. So if you have any questions about some of the content or follow-up from any of the items from today, please don't hesitate to contact your advisor. If you don't have an advisor, and we love the opportunity to work with you and earn your business. These are exceptionally challenging times, as John and I both talked about, in the financial markets, and I'm a big believer that having a steady hand to help you navigate today's markets will lead to better long-term outcomes. So with that, we will change up the Market Matters format. We'll give you a little bit longer lead time on some of the special guest speakers we'll be lining up. So look forward to that in your inbox, and we look forward to speaking with you soon. Thanks, everybody.